Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall. He's Jeff Santoro. He is my good friend. He is the voice of the people. Hey Jeff.
Hey, how are you?
I'm good. We're recording this a little bit different time than we usually do. We usually record it in the afternoons, kind of early midweek. We're recording this on a Friday. Happens to be August 2nd. And boy, oh boy, has August started off pretty tough for investors.
Yeah, as we're recording this, it's about, what time is it? It's about 10:20 in the morning.
10.
Yeah,
Market's
it's
been
20
open
after
about
10,
an
market's
hour.
open, and it is an absolute bloodbath, at least right now. So when this episode drops in 4 or 5 days, it'll be fun to see what has happened since. But
Yeah.
after yesterday and today, yeah, August is off to a rough start.
And I think we'll talk a little. It's not, it's a little bit kind of ironic, the show that we're going to do today. A hat tip to our good friend Tyler Crow at Misfit Alpha. We'll put the link to his Misfit Alpha in the show notes. But we have a text kind of chat group with a few of us, and he suggested this idea of when you own stocks and they go up, but not for the reason that was your thesis or that you expected.
Yeah. And I loved this idea immediately because these are the things that I talk about when I go through my portfolio and I think just generally about having less stocks, which I do, I don't know, like every day.
Yeah.
I'm drawn to the bottom, right? I tend to look first at the ones that have been losers for me. But there are some times I look at the top at my winners and say to myself, like, even though this has been a winning stock for me, it's not for the reasons I bought it.
Right.
And I ask myself that question of like, so if it were the other way, would I still own it? So I think it's a fun thought exercise, and I'm looking forward to kind of talking through it.
Me too. So we're titling this episode "Getting It Wrong and Still Making Money," and I think that's like if I were to write a autobiography at some point, that might be the title of my
Yeah,
autobiography.
that would be a good autobiography title, especially
It's a
for
good
you.
one.
You
Yeah,
get it wrong a lot,
a lot.
but here you are.
Here I
You've
am
you've made it. You've made it
again
this
on
far.
my own, going down the
So
only road I've ever known.
I think I think a good place to start, and this is one of those things that I understand now but didn't understand when I started. Let's talk about all the different reasons why stocks go up,
Yeah.
because it's not always there's not ever one reason, and it's not always for the reason you might expect. So let's start there. I think that's a good place to kick off the conversation.
I want to start with like the most objectively pure reason why stocks go up over the longest term and why they should go up. And this should be kind of the basic thesis for most of the investments most stock pickers are make. And even if you're just an index investor, it should be the same thing. And that's when you buy a stock, when you invest in a stock-based index fund, you're buying a little fractional ownership of a real business. And the goal of that business is to sell whatever it sells, to earn money, to make profits, to generate cash flow. And over time, you grow that, the business is going to become more valuable because it's more profitable. And if you look at stock market returns over the long term, it correlates directly with earnings growth, right? That's the purest driver. So if you think about, owning a company is owning a percentage of those cash flows or profits, as those go up, the valuation stays the same or even normalizes lower, the value of the company is going to go up, right? That's the purest thing. It's you invest in a business, the business becomes more valuable, your ownership goes up.
Yeah. And what I think what's hard about that when you're a newer investor is you don't always have that long-term perspective or knowledge, and you're looking at things in the short term.
Yep.
So, and that can be day to day, hour to hour, minute to minute, or even quarter to quarter or year to year, right?
I mean, 5 years is a relatively short term
Yeah, right.
if we're
And
being
in
honest.
and so the flip side of that coin that you just described is that in the short term, you can have a stock that you bought for that very pure reason, right? I believe in this company. I want to own a little piece of it. I expect profits and cash flows to improve over time, and then the company will be more valuable, and I'll own part of a more valuable company. But in the short term, sometimes none of those things are actually happening, and the stock
Right.
is going up anyway,
Yeah.
right?
Yeah.
So like
Yeah.
that's the other way that stocks go up.
And the best way to think about that is multiple expansion, right?
Right. So when you hear the
Um,
term multiple expansion,
yeah.
that's basically what we're talking about.
And a lot of times, like, we hear that and we kind of, think of it as maybe kind of a bad thing, right? Because it's like, well, the business hasn't really, quote, unquote, "earned" the higher stock price. Investors are just agreeing to pay a higher multiple for it.
Let's define multiple. So like that's a
Yeah,
generic term for like all the typical valuation metrics you hear, price to sales, price to earnings, price to cash flow, things like that.
right, exactly. So and I don't wanna get too deep in this, but basically the way that works is if a stock trades for 20 times earnings, your investment today, if the company's earnings stayed exactly the same and they were giving 100% of those earnings every year back to investors, which they don't, but this is just kind of the proxy to think about it. It would take 20 years for you to fully recoup your investment in earnings giving back to you, right? So that's kind of how you think about these price to earnings. And it's not literally in years, but it just works out that way.
Yeah.
Um,
Another way I think
so
of it, another way
yeah,
I like to think of it is I think as consumers, it's very easy to think about getting something for a discount. So if I go to the store and there's a shirt for listed for $20 and it's on sale and I buy it for 18, I bought it at a discount.
right,
I like to think of multiple expansion and like the way the stock market works is sort of like the opposite of that. Almost like you
right,
go into a store, the sticker price for the shirt is $20, but you want it so badly or you believe it's going to go up in value because it's like this cool shirt, you're going to pay 25 for it.
right,
And
right.
that's kind of because you we're always talking about positive numbers in these multiples, right? 20 times
Yeah,
sales,
yeah,
30 times sales, 10 times sales. That means you're paying 20, 30, 10 times the current value or at
right.
least what the so because you're assuming it's going to go up later.
Yeah. Yeah, no, that's exactly right. So the idea is, again, the lower the multiple that you can pay on these valuations, the bigger bang for your buck you're getting,
Right.
right?
So multiple
Generally.
expansion is when that number is growing. 10 times
Right.
sales is becoming 20 times sales is becoming 30 times sales,
Right.
but
So
maybe
think about it this, and I don't want to use sales. I'm tired of using
earnings. Okay,
sales.
fine.
Yeah.
Yeah,
So
yeah, yeah.
let's say earnings. So let's say a company trades for 20 times earnings when you buy it. And a year from now, their earnings haven't changed. They earn the same amount of money. And the stock is now trading for 22 times earnings. The stock price just moved up by 10%, assuming everything is the same, right? The stock has moved up 10% in value because, 20 to 22 is a 10% increase. That's multiple expansion, right? The stock price moved up, but the business didn't do anything to create additional per share value, right? So that's what we mean by multiple expansion. Now, I want to say this, like a lot of times we kind of think about that multiple expansion is maybe kind of a negative connotation, but I don't think that's always necessarily the case. A lot of times, like Amazon is a good example. The stock's down like 17 or 18% the past few days. They just reported earnings. Markets doesn't love their guidance, and stock's down like 11% today, August 2nd, but it's up 92% over the past year. And now a lot of that is earnings growth, right? They've done a lot of efficiency stuff. We talked about it before, right? So they've fixed some stuff in their business and they've gotten leaner and they're growing more profitable parts. So their earnings have grown a lot. But we're also still seeing some multiple expansion on top of that, right? So both things are happening at the same time, where earnings are going up, but the multiple investors are paying is still higher than just that earnings growth, right? So, but my point is, Jeff, when we were talking about Amazon at the beginning of 2023, part of your thesis was some multiple expansion. Just the market had discounted the business so much at that point, the market was discounting the management's ability to kind of right the ship and start generating profits in some areas that had gotten ugly. So the multiple expansion that you've seen actually was part of your thesis, that it was the market was going to more appropriately value the business.
Right. It was almost like I expected the multiple expansion to bring it to a valuation that was reflective of what I thought the business could do. And I think
Right.
that's the
And
piece
more
of it.
reflective of how the market has historically valued the business, because
Yes.
it wasn't.
Yeah. But I guess the way I was thinking of it too is like stocks go up on the multiple expansion side of things, I think for kind of two reasons. One could just be exuberance and momentum, right? Because
Right.
and we'll talk about short selling in a second, which can be like a version of this. But like if I'm excited about Amazon, I go buy it. That's going to drive the price up, and then you're excited
Right.
because you see the price going up, and then you buy it, and then the next, and then it kind of builds
Yeah.
upon itself. So like that's part of it. But part of it too is people who are more sophisticated investors are doing all sorts of calculations and thinking and projections about like where they think the company will go. So like
Right.
that will drive the value up as well. So sometimes when you see a very high flying, high growth, at least on the top line, company that people are excited about, some of it's just emotion, but some of it is like legit. I could see this company 10xing its revenue over the next 5 years because I have so much belief in this product,
I
and
can
that'll drive
use
the.
I can use 2 stocks that both have gone up a lot for multiple expansion reasons over the past year and a half for kind of both of those 2 reasons that you were just talking about. So, we talked about Amazon, but you could say the same thing about Meta, right?
Mhm.
Meta was a deeply discounted value play, where it was just trading for a really, really cheap earnings multiple, cash flow multiple, whatever you wanna use, because the ad market was weak and they were still plowing money into Reality Labs. Here we are a year and a half later, they're still plowing money into Reality Labs, but they did get a lot leaner in their operations, and the ad market has bounced back and their growth rates have bounced back, right? So that was a great value play. And then we could say the same thing about NVIDIA, where this was never a value play, but two things happened. Number one, business boomed, right? All the AI stuff has boomed, and the market increased the value of the stock without multiple expansion. Just because, well, your earnings go up that much, your business should be worth that much more. But then we have seen multiple expansion on top of that
Because
because of
everyone's
the
excited about
momentum,
AI.
right? Because of the momentum thing.
Right.
Exactly. Right. So it's never just one or the other. It's rarely just one or the other, right? But over the long term, over the very long term, you think 10, 15, 20, 30, 50 years, earnings growth and market values tend to go up kind of hand in hand. So that's how multiple expansion can play a role. And like I said, sometimes it can be part of the thesis, right? It's not always just a bad thing.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. So let's talk about short
Yeah.
squeezes
Yep.
because you do hear this in the news sometimes when a stock really goes up in a short amount of time and people are kind of confused about why. Like sometimes this happens not even around earnings, but if there's like one piece of news that might trigger some excitement, you'll see this. So why don't we talk about what short squeezes are?
Yeah. So first thing I want to say is that I think short selling is an important and necessary part of a healthy stock market. Andrew Left, I'm sure most people have heard about Andrew Left, the guy behind Citron Research, I believe. Is he Citron? I think he's Citron Research. Noted short seller, had a couple of big short wins about a decade ago. He's actually the SEC, I think it's the DOJ or charging him for market manipulation. Like he's in trouble because a lot of the actions that he was taking allegedly.
Yeah, he's.
So
I googled him to make sure that it was Citron Research, and it is. And he
yeah,
actually
yep,
surrendered himself to authorities 4 days ago. So
yeah, yeah. So it's yeah, he's been charged with some pretty big stuff. But the short version is a lot of times associate short sellers with the Citrons and the Hindenburgs and these bombastic, scary, long reports they put out that are 95% things to scare retail investors out of the stock to send the stock price down. And then they make a quick profit, right? Because they short it before, they release their research, and then they close out their position and they make a profit. So a lot of times that's what when people think of short sellers, that's what they think about, kind of the nefarious negative. But the vast majority of short action that happens isn't people that are out there with a platform.
mhm,
It's just they look at the business and they say, well, this valuation is stretched. I think the valuation is going to come down. So it's multiple. They think multiple contraction is
right.
going to happen,
Yep.
or they've identified some flaws with the business, right? That they think are going to cause an issue.
Yeah. What
So they
I've
short the
never.
stock.
Yeah, I've never shorted, but I've listened to podcasts and things where like short sellers
Yeah,
are interviewed and stuff. And
right,
yeah, it does seem like it's those two things. It's someone believes this is a fantastic business, but the
right,
valuation makes no sense and they'll short it, or they think, I think this is a fraud and they'll short it.
right, right. Exactly.
Or
And
some
and you can
combination of the two.
and the way you short stock is you borrow shares from someone, and just like borrowing anything, you pay interest to borrow it, and then you sell them short. So I could borrow a stock that's, let's say, it trades for $100. So I borrow the stock and I pay the interest rate, whatever it is, to borrow that stock. But then I sell it for $100. I sell those 100 shares that I borrowed for $100. So now I have, was that $10,000? At some point, I'm going to have to give those stocks back to the person that owns them, which means that I'm going to have to buy them back. So the way that a short seller profits is I sell that stock short at 100 and then it drops in value, right? So it drops to, maybe my target is 75 and it drops to 75 and I buy it back, those 100 shares, for $75. So I just paid $7,500 to buy those shares back. So I've made a $2,500 profit, less interest that I pay, right? So that's how shorts make their money. So here's the mechanics of a short squeeze. A short squeeze is when a stock that is heavily shorted, and I would say a stock that's heavily shorted could be like 5% of the float, right? 5%.
And just real quick, you can see if you go to any website that has stock data like Yahoo Finance, it'll tell you
Short
what percentage of
interests,
the shares are sold short. And
right? The
sometimes it's even
percentage.
sometimes you'll even see more than 100% of the shares are sold short.
And that's like a mechanical glitch in the way a
Yeah.
lot of these systems report the data. You can't actually short more than the float.
No, I
Um,
know that, but what I'm saying is
yeah,
that's an indication that it is heavily
right. No,
heavily sold
exactly right.
short.
Exactly right. So, but again, it could take 5% or less to cause a short squeeze. And here's the mechanics of a short squeeze: you have a fairly large amount of shorts, and a lot of this is going to kind of come down to volume of stock shares that trade for a company. So you might have a small percentage of shares that are sold short, but if it's a stock that has a low volume, it doesn't take much for that squeeze to happen. You could have a larger percentage of the stock that turns over a lot of shares, and it might be less likely for the stock to move as much with a squeeze.
But can I want to ask a clarifying question.
Yeah.
I think this is where you're about to go next, but I think
Mhm.
it'll help people frame it. So when you buy a stock long, right? Because you think it'll go up, the most you can lose is 100%.
Right.
But am I correct in assuming that when you sell a stock short, you can lose more than 100%.
Oh, many multiples of
Right.
that.
And
So
so this is this first step of the squeeze.
right, exactly, and this is what causes squeeze to happen. It's like somebody screaming fire in a crowded auditorium. The panic happens and people try to rush for the exits.
Right, because
So
if the stock shoots up, you're
yeah.
watching your
So
loss
here's
go
the
from 80 to 100 to 150. You're watching
so
your
here's
loss
the yeah,
build
here's
up.
the mechanics, right? Here's the mechanics of how it works. And the other thing too, you can actually use options to do shorts, like kind of a synthetic short. So like if you could buy puts, for example. So you're long at a price that could be exceptionally higher. Now, but if you're buying a put, you're long the puts, but what you've done is paid somebody to give them you've paid somebody else for them to give you the right to sell them a stock at a set price, right? So it's a way to short a stock because you think the stock price is going to fall. Again, it could be the same thing. You could buy that put at $100 and you think the stock's going to fall to 75. You could force, you could put those stocks to that stock to somebody else, right? At that price. So it's another way to be short. But kind of back to the point about the short squeeze, because this is the whole like somebody screaming fire in a crowded room thing is that what happens is that when you have a lot of people shorting a stock, typically they're shorting it for kind of the same reason. And they're looking for, I don't want to necessarily say a binary outcome, but they're looking for events to happen that are going to drive the stock price down so that they can profit. And typically those things are going to be around earnings season because usually they're shorting a stock because they think that whatever the thesis is flawed. And then there's things that are going to undermine it. The business results aren't going to be good, whatever it may be, right? And there might be, and there's some of it where they think there's a fraud there, but the key is that whatever the event is that happens is the inverse of what the short thesis is. Maybe the idea is a company's revenues are going to start declining, and then they report a blowout quarter. Revenue's good, generating profits, and then they give really good guidance too. So that's the catalyst that starts the dominoes falling where you have some shorts that try to get out quickly. So the way that you close a short position is you buy back the stock, right? So you buy back the stock to close the position, and more shorts do the same thing. So they're putting in these buy orders to buy the stock, and they have to bid up and keep bidding up to get their price. And you can see a stock price go up 10, 15, 30, 40% in a single day sometimes when these events happen. And it's not people that have a long thesis that are rushing into the stock. It's shorts that are doing everything they can to get out as quickly as they can to limit their losses. Because again, you bought that stock at 100 or 10, whatever, and next thing you know, it's 12. Well, guess what? You've already lost 20%, right?
Right. And what
It
I've
could
noticed is you tend to see it a lot when like the results are good, but not great. Like you're like, oh, that was a good quarter, nothing crazy. And then all of a sudden the
but
stock's
it
up
doesn't
20%.
justify this happening. Right. Exactly.
We've talked a lot about all the reasons that stocks might go up. I think the last one that we had on our little outline here that I don't think requires much conversation, but it is just now we're in a world where the YOLO Redditors can drive a stock price up just because they decide they want to.
Right. Right.
Um, Fortunately, that's a handful of stocks it seems like they're interested in. So
Yeah.
the chances of you being involved in one of them are statistically low. So we don't have
Yeah.
to spend a ton of time on it. But let's get back to the original sort of thought about this episode, which is around. So we've established all the different reasons stocks can go up. And I think we've nicely distinguished between the short term, non business fundamental reasons as opposed to the long term and sometimes short term business fundamental reasons. But what about the idea that sometimes stocks will go up for reasons other than what your thesis was? And let's stick to the fundamental piece, right? So let's put all of the crazy market, you know, shenanigans on the side for a second and just think about you own this company. It's really doing well stock price wise, but you're looking at the results going like, I don't, this is not why I thought it would go up.
Yeah. So, I mean, the classic example is like an Amazon that we can reference back to again. And anybody that bought the stock anytime in the, through 2010, 2012, 2013, your thesis is still based on e-commerce. And yes, e-commerce has done well. It has, and it's grown. But if you look at Amazon's business today, the first obvious example of a massive thing that you couldn't have been planning on a decade or more ago is AWS, right? It's still, I don't know, what is it, a quarter of revenue now? No, it's still less than that, but it's a substantial, sizable portion of operating income and cash flows. It's the profit driver of the business. You Could you have possibly imagined them being a movie studio or a TV studio, right? One of the things in their press release yesterday was, I don't know how many, like 25 Emmy nominations or something like that. And Fallout, one show, 16 Emmy nominations. So the ecosystem that they've built, how much broader it is than could have been part of the thesis, is incredible. So that's the first easy example that comes to mind.
Yeah, and just to put numbers on it, AWS revenue is about 18% of total revenue.
There you go.
Um, but it is, I'm not gonna do the math in my head, but on an operating income basis, it it's, let's see, $9.3 billion versus North America, which is basically e-commerce in North
Yeah,
America is only 5 billion, right? So
right.
almost double the operating income coming from AWS despite being 18% of revenue.
And if you look at their guidance for the third quarter, it might actually be more than 100% of everything else operating income. Right. It's become a remarkable portion of that business. Is there a you have a you have an example?
Yeah, but I just wanna add on too, like, I think there's even a potential second act to the Amazon story that you're talking about, because for the
Yeah.
last couple quarters, the fastest growing segment in terms of revenue has been AWS, but the second fastest growing has been advertising,
Advertising. Yeah.
right? So, and advertising is still only, let's see, 9% of total revenue, I think. So it's still, it's growing, but it's only 9%. But still, it's the fastest growing piece. So let's say a decade from now, that grows to be 18, 20% of revenue. Again, that's not something that necessarily that you saw coming. I don't know that I have a specific example where something in my portfolio where something went up for a
Yeah.
reason that other than why I bought it. Although I guess if I was going to say pick two, I think I would talk about, well, I want to talk about cyclical stocks in a second because I think they can go up for reasons you're not expecting, but I think it's a little bit different. We'll come back to that. But the two that popped into my head, Arista Networks and Broadcom, and I've talked about them a bunch of times in tandem because I feel like they have just rode the AI tailwinds.
Mhm.
But I think you could almost broaden it out for anyone who's invested in the semiconductor or related semiconductor space in the past 18 months. You probably did not have AI on your thesis bingo card, and if you did, it was maybe just, oh, and they also play around in AI, not like, oh, AI might be the primary business driver for the next several years.
Right, right.
And yeah, so I think like if you're looking at it from the standpoint of like, why did I buy this stock and why is it up? That could be a huge disconnect because there's some big transformational thing that happened that is morphing, if not changing the thesis. Here's another one that just popped into my head, and it's similar to the Amazon example, but how about Microsoft,
Absolutely.
right? If you bought Microsoft in the 80s or early 90s, you
No,
bought it because
if
of,
you bought it in 2010,
right. Fine. Yes. Same thing. But you bought it for Windows,
well, right,
right? Like
right.
you bought it for Windows and for, Microsoft Office and Excel. And now I think the biggest part of the thesis is forgetting AI for a second is the cloud business, right? That's their
Yeah.
second or third for cloud
Well,
infrastructure after
I would go
AWS.
even further with Amazon than that, or with Microsoft than that, because they've become so deeply embedded in the enterprise broadly that they would.
Yeah, but that's still
The cloud was
driven
part of that.
by but that's driven by the original stuff, isn't it? Like,
I mean, yes and no. I mean, I think yeah, yes, but there have been kind of cracks in the armor there with, like some of Google's tools and other things that have been developed serve a lot of those same purposes. But the fact that it's kind of this integrated, for fully, vertically integrated offering across everything that they do is so powerful. And you're a Mac fan. You can do everything that Microsoft offers on a Mac too.
mhm.
And it can feel just as integrated. That was not the case a decade ago, and it's becoming more of that. But I agree with you. I think the cloud has been a big part of that. It really has.
So
Here's one.
go
I
ahead.
have one for you. We've already mentioned it here, but I mean, I think NVIDIA is about as classic an example as you can get. And we don't even have to talk about the AI stuff that's happening now, but think about how important Bitcoin was in the prior decade to NVIDIA's sales
Mhm.
for mining, right?
That
Um,
was the last sort of boom and bust that they went through prior to
yeah,
the AI
yeah,
stuff.
and they generated a massive amount of cash flow from that that funded further investments that have led to the investments in CUDA and their GPU hardware for AI. So I think that's another really good example.
All right, so let's talk about when a stock goes up and it's entirely because of multiple expansion.
Okay,
And I want to first talk about cyclical industries, and then I want to talk about 2021 because
love it.
it feels like in 2021 almost everything was because of multiple expansion, and I made a lot of stupid mistakes because that happened to coincide with when I was still a relatively new stock investor. But I want to know what you think about cyclical industries because Texas Instruments is a stock that jumps out to me for this. All of the results for the past several quarters have been bad in terms of things trending in the wrong direction. Revenue growth is slowing, profitability is worsening, cash flow is decreasing. Like pretty much any metric you'd measure if you chart it over the past whatever, year to 6 quarters, it's heading in the wrong direction. Yet at the same time, the stock continues to go up. I believe it recently in the last couple weeks it hit an all-time high. And so that would be an example in my mind where if you weren't looking at the business and just looking at the stock price, you'd say to yourself, "Oh, they must be crushing it." And then you go and look at the business and you're like, "What? I don't get it." Now, my
Yeah,
best assumption as to why this is happening is because everyone who knows this industry knows it is cyclical and that we are in the down cycle, but people think maybe we're at the bottom, just past the bottom, and it's trending back up. So I think the multiple expansion you're seeing despite the results is because of exactly what we talked about earlier. People are seeing the future, right? They're
yeah.
projecting that this too shall pass. They'll be back to their dominant position. The numbers will improve, and the stock's being priced as such. What do you think about that aspect of it when it comes to cyclical industries and multiple expansion?
Yeah, no, I agree. I think Texas Instruments is a perfect example. So just for the uninitiated, Texas Instruments, their primary business is making analog semiconductors, which are important broadly for, I mean, the entire tech industry. Because if you have, you know, a chip in a smartphone or a computer, you need analog semiconductors to get power in and to connect digital devices and information to the real world. That's kind of how they describe the business. So that part's actually that part of the semiconductor industry, like most parts of the semiconductor industry that are not AI, have been in a cyclical downturn. Industrial demand is down. The auto industry's kind of down right now too. So demand from there is weak, and those are major markets for Texas Instruments. So going back to July 1st of 2022, so close to 2 years ago, operating cash flow is down like 28%. Stock's up 22%, right? So that is clearly a case of massive multiple expansion on the cash flows basis, right? Because people are paying 22% more for 29 almost 29% less cash flows. Um
And this brings up an interesting point because you said earlier that people sometimes when they hear multiple expansion, they think it's a bad thing, right? They think like, oh, this stock must be, getting bubbly or it's detached from its fundamentals. And I think that's the case. And again, we'll talk about that when we get to our next topic, which is 2020, 2021. But in
right.
the case of a company like Texas Instruments or something in a cyclical industry, I don't think it's necessarily a bad thing. It's a realization or the market sort of
Well, if you
understanding
like
that.
if you don't follow the company and understand the industry that they're in and where they are in the cycle and like the long-term tailwinds or headwinds depending on the industry that it's facing, then it's easy to just say, yeah, the market's become detached from reality. This is dumb. It doesn't make any sense. But Texas Instruments, like they're spending billions of dollars in capex to expand their capacity and also doing some things that are going to drive production costs down and add margin, like a lot of margin to what their bottom line. So
But the danger is now they've set a certain level of expectation for when the cycle swings back up,
right,
right? This is what
right.
I think about in terms of like, do I want to add to my Texas Instrument position? And I haven't because it's priced like it's at the top of the cycle,
Yeah, no,
even though it's
exactly.
at
Well,
the
and that's
bottom.
why, that's why I was pounding the table about Texas Instruments 2 years ago and, kind of late summer, early fall of last year, call it 9 or 10 months ago, when the stock price was down, right? When the market was not betting on the future as much.
Right.
And
But
that's
now
the key.
and
Go ahead.
it's dangerous now because like this is the way I'm thinking of it. You can tell me if you disagree. Now they have all this expectation built in, and the numbers have not started to even tick back in the right direction yet.
Right.
So now it's like, okay, so let's say when they report this next quarter, it starts to. But let's say we get to like the top of the cycle in another, whatever, 12 to 18 months, and they're not quite living up to expectations. That's a recipe for stock price disaster,
I
So
mean, that's the thing, and that's why when you think about these cyclical stocks like that, like, this is where valuation really matters, because you do wanna be hopeful that you do get a little bit of multiple expansion if you buy the stock right, right?
yeah.
If you know the industry and you see, and again, the bottom line is, like, the valuation, even when Texas Instruments stock was, 30-40% cheaper than it is now,
Still
based
wasn't
on
cheap.
prior 12 months during the downturn, it still looked expensive.
Yeah.
So when you think about the multiple, you have to value the business based on kind of the midpoint of the cycle, like what are it's like its true earnings potential in during a healthy part of the business cycle. And that's where you have to put in the work, right? You have to imagine, well, okay, here's where the earnings are going to be or could be. Here's where the cash flow per share could be. Here's where the stock price is now. Does this stock price make sense based on what I think its earnings will be when the cycle turns? And then you have to be patient, right? You have to wait through everything while still, focusing closely on the business, because like in a case of Texas Instruments, it's not just the cycle turning. It's, the, I don't know, call it $20 billion through this part of the cycle that they will have deployed into growing their capacity, into making these process improvements.
So they're
Then
ready
it's
for the
execution.
upturn.
What's that? Before
So
the upturn, right?
yeah.
But then it's execution risk that is on top of the market turning, right? So you have to have expectations that earnings are going to be much higher in the future than they were at the prior peak, because of all the money that they've spent and because of the semiconductor industry's growing, the tailwinds that are driving it over the long term. So you're paying this higher multiple today, this higher price today. You don't have that margin of safety.
Hey, everybody, we'll be right back. But first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures and podcast description. U.S. members only.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as NVDA and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
All right, so I want to talk about 2020 and 2021 and what kind of happened in the market then as it relates to multiple expansion and that kind of a thing. Because the core question we're answering here is, what do you do when a stock goes up for reasons you weren't expecting or are not related to the business? And I think everybody faced that to some degree during that year to 18 months.
Mhm.
And here's my summary of that time, and you can tell me if you think I have it nailed down. So I think there was kind of two things happening. One is there was just a lot of excitement and a lot of companies that had no business coming to the market and or being bid up were. And I think of all the SPACs, I think of the pre-revenue companies that came public that really had nothing to show for themselves other than like a good story and some excitement and hype. There was like
Mhm.
a lot of vibes multiples going on. But then because we were in that world of low interest rates, the market seemed to really value top line growth and customer growth. So if
Right.
you were a software company on a subscription model and you were posting 50, 60, 70, 80% revenue growth and customer growth, it didn't matter what happened below the gross margin part of the income statement. It was like that could be a sea of red.
Yeah.
And it didn't really matter because you could go borrow as much money as you wanted for 0%
Mhm.
and wait 2 decades to grow into profitability. And the market was willing to pay for that. But to your
And investors with lots of cash that were looking for some sort of return were risking on.
right.
In
Because
other
where else
words,
were you going to get any kind of return?
risking on defined as buying stock in a company and being a part owner in the company where you're at the bottom of the capital stack. You're the last person to get paid when things go wrong versus buying debt, which is the best place to be because you're the first person, you get
Right.
paid before everybody, right?
Yeah. And then going back to, I think one of the very first points you made when we started recording about basically you as the investor wants profitability and cash flow. Like that's your stake to the business. And that's what
Mhm.
it grows over time and makes your ownership in the business more valuable. That was the piece that was missing for a lot of these companies in 2020 and 2021. So people were willing to pay high multiples for top line growth with nothing that actually benefits shareholders, at least in the short term, because of vibes and hope and dreams and YOLO and rocket ships.
Yeah.
So
Yeah.
I think it's a very good encapsulation of what can happen in that kind of a bubbly, frothy time and how it can really lead to some bad investing decisions.
Well, the two examples that stand out to me is like, so I can understand a lot of software as a service, cloud, like a lot of that stuff got bid up because the growth rates for so many of those businesses were, and a lot have been, exceptionally high. And like their basic business model is super duper high margin. Like you get 60, 70, 80% margin, gross margin, and like your base operating costs are growing at, 10% a year, 15% a year, and your top line's growing 30% a year. You're going to get to operating leverage fast,
Hmm.
where you go from a sea of red to just cash raining from the heavens, right?
And then you just print money forever.
Yeah, yeah. And well, until Delta Airlines sues you because you caused them to cancel 8,000 flights and cost them $500 million over an 8-day period. But um,
Yeah.
the barring those black swan events, like the basic thesis made sense where a lot of those get bid up. But then you look at like Delta Airlines, all of the airlines and the cruise ship operators, those stocks were going bonkers in 2020, and especially the cruise lines. They're like, we might not be sailing for a year, and they were spending hundreds of $1 million a month to stay in for like their minimum operating cost to keep their fleets, functional. But investors were acting like they were gonna double their capacity and open for business in a month. So a really good example of like, being wrong and still making money.
So let's pivot to what to do when this happens, right?
Yeah,
So
yeah.
I guess the question is, should it, should investors reconsider a stock holding, a position in our portfolio when we see it shoot up for reasons that are maybe detached from the fundamentals?
I think you have to, if you're a business focused investor, and I think any long term investor, you have to be business focused because again, what is the what is the driver of returns over the long term? It's earnings growth, right? Earnings per share growth. And if you need to think about your thesis for the business, if it's the stock's going up for reasons other than what your thesis were, is the same as if the stock is going down for reasons other than your thesis. If your thesis is not playing out, you have to revisit it. You do. And you adjust accordingly. And maybe that adjustment is, wow, this really isn't working, but this other thing happened that's working great. And all the evidence is that that's going to continue to working great. I'm going to remain long the stock. But you might also realize, wow, I've just gotten lucky and I've made money, but the reasons I invested aren't proving true. There's some good multiple expansion that's happened here, and it's created an opportunity for me to move on. You do that just as much as your analysis of a stock that's not doing well is the thesis is broken and you don't see a way forward, you sell and move on. I think you have to.
All right, I'm going to push back a little bit.
Okay.
I don't know that you have to sell and move on. I think it's
But I'm
okay.
saying if you're go ahead, you go ahead. Go
I
ahead.
was just gonna say, I think it's okay in a lot of cases. All right, let me back up. I think if your vibe is or your way of investing is, I have a very defined reason for owning this company, and if it goes up or goes down for reasons other than that, I'm out.
No,
I don't know.
I don't think you should do that.
Okay,
Yeah.
but I'm saying I don't
Yeah.
necessarily think that that's a bad thing if that is the way you have to if that's the way you are as an investor, right? We talk a
I
lot
think you're
about,
too rigid and you need to buy index funds.
but I think what I would do is in both cases, and I think this is where I end up when I ask myself this question, like I said earlier, like when I look at the stuff that has done well and I'm like, but not for any real reason.
Yeah.
I'm much more of a wait and see kind of a person because I'm also, I challenge the idea that I don't think theses break as much as some people say they do. I think people who are like, oh, I sold because the thesis was broken. I think for a lot of people, that's
That
not the
just
reason
means
they
they lost
sold.
money and they don't know what to do.
Yep. I
Yeah.
think that's the
I
reason
agree.
they say they sold. And the reason I think that is because you never, ever, ever hear someone say, oh, that stock was up 80% in the last 3 months, but my thesis was broken and I sold.
Yeah.
So I think if people were
Yeah.
really
Oh, that's fair.
thesis driven investors, you'd hear about it on both ends. And some people do that. I'm not saying, but the vast majority of people I think don't. So I think when a thesis changes, I do think it's appropriate to kind of wait and see. We've given examples, right? Like, so I don't know what it would have been like to be an Amazon shareholder and then learning that they're investing money in AWS. I don't know what it was like to be a Netflix shareholder and have them be like, hey, this really great DVD mailing business we have? Well, we're going to now stream.
Right.
Like,
Have
I,
you heard of the internet?
right. I might have at that time been like, well, that's stupid. Why would you do that? Like,
There's no
and then I might
barriers
have,
to entry. The
right.
big studios are gonna blow you out of the water. Yeah, like, absolutely. No, I
And,
agree, I agree. But
and
so
we've talked, we've debated this a little bit too with Boston Omaha, a company where I completely understand why some people think the thesis is broken and sold.
well,
I
we've all
think,
been wrong and nobody made money
I
except
think,
for the insiders.
I think the thesis has changed.
It has to.
And
But the original thesis is broken. And my point was, and this is what I wanna show it is broken.
I don't,
It is Yes, let me explain why.
I
Let me
think,
explain why, because
I
I think
think well, hold on. I will let you explain, but let me say this. I think a thesis you could have had is broken. I don't know that it's everyone's thesis. Go ahead.
if it wasn't, then they're lying. They're
I
absolutely lying. Because now
b
hear me out,
I'm
okay?
gonna say I'm not lying because I don't think my thesis for owning the company is broken, but go ahead. You go, and then I'll tell you how you're
You
wrong.
didn't have a thesis when you bought the stock then. So,
No, but I developed one.
there you go. Mission creep, ladies and gentlemen. This is called mission creep. So, this is the most important thing I think I can say about it when it comes to having a thesis. As an investor, I think most people spend way too much time trying to confirm their thesis when we should all be spending more time trying to disprove the thesis. We should always be constantly looking for evidence of why we're wrong, why things aren't working, more than reasons why that we're right. And the reason why is because the stock can be performing poorly because the business is not doing well, but we're still convinced about our thesis. This is going to happen. This is going to happen. This is going to happen, right? Confirmation bias is the key here. So if you spend more time constantly trying to poke holes in the business and the thesis that you built, you're going to arrive at a better place. And this is important because objectively, when you realize that the thesis that you developed was incorrect, it allows you the chance to either either evolve your thesis based on the reality of the business that you're learning about, or move on if you determine that there's just nothing valid there that supports you continuing to own the business. And that's what I wanted to get to is that, and I think the thesis has to evolve for most businesses over time because business models change, opportunities change, competitive environments change, technology changes, right? Like, so all of those things kind of come into play. So I definitely agree with you that for most people, the last action should be selling or buying more. It should mostly be learning and evolving your understanding of the business, and your understanding of the business is going to inform your thesis. So that's the biggest thing that I wanted to stress.
And I agree with everything you just said. Here's where I want to give
You're
an
still wrong about
example.
Boston Omaha.
Well, I do, but I want to do it not necessarily to defend myself, because you're right. I bought it because I bought it because I was the ticker guide on the Motley Fool discussion boards for it, and I was interested. And I was like, "This is cool. I'm doing this. I'm going to buy something." Like, that's why I bought it. And then I learned about it. But I'm going to use it as an example of where A, not everyone owns something for the same reason, and B, I do think one person's busted thesis can be another person's changed thesis. So my
Agree.
basic
100% agree
right. Well,
with you. That was
that's what
yes.
I'm getting
Yes.
at, right? So
Yeah.
I'll use I'll use Matt Frankel as an example, because he has written and spoken about Boston Omaha very publicly on Motley Fool podcasts, on
Yeah.
articles he's written on his own YouTube channel. We've talked to him about it in person when we've seen him at events. For him, the thesis, or the thing he was most excited about, was the thing that has changed, which was the asset management part of the business. That was
Right.
his, like, I think this is going to be the driver for the future. So when that went away, I don't think he has sold. If he did, I'd understand it, because for
Yeah.
him, that was the reason to own the company. I was always more interested in, I guess, the optionality provided by cash generating businesses, right? So for me, it was about, if broadband and billboards and insurance can be cash generating profitable businesses, they can then use the proceeds to do X. And I didn't necessarily care what X was. So if X was investing in Dreamfinder Homes and then cashing out after they IPO'd, cool, which is what they did. If X was sponsoring a SPAC that became Sky Harbor, which is what they did, cool. If X was starting an asset management business, which they wound down, not great, but okay, because for me, it was never about the asset management business, it was about X. So that's why for me, the thesis has changed and is not broken. And I want to see now what they do. Right. So now, if a year from now it's the same bullshit and nothing has really changed, and
Yeah.
they haven't done any X, it's just, here's what these three businesses are doing, I might be out, because I'm not seeing that part of so I guess that's my main point. Like, it's not necessarily
Okay.
about Boston Omaha.
So I think this is kind of a matter of maybe defining the difference between a change thesis and a broken thesis. And
Yes.
my
And but that nuance I think is important.
no, I agree. I
Yeah.
absolutely agree. So my definition is a broken thesis is there something about your original reasoning for investing in a business that has so fundamentally changed. If you will intend to continue owning the business, your new thesis is going to be fairly radically different than the one that it was before. Now, where I think this is important for Boston Omaha is that, sure, optionality from the cash flows from their existing operations to be able to pursue ways to generate more return. You could say that about every business, whatever they do. I mean, you could use Amazon as we'll go back to that one because it's the one that we're talking about. Like, they invested in, like, this what's now a cloud infrastructure for themselves. Like, they built it for themselves to host, Amazon.com on, right? And they realized that, well, there's lots of value in a lot of this capacity that we're not always maximizing that we can sell, right? So that whole first best customer thing, they like, you can say optionality all you want about any business, but eventually at some point the optionality thing, when it's wildly successful, becomes more valuable than like the original core thesis. And when I say it's broken for a company like Boston Omaha, is the optionality is gone, because the optionality before was to fund internal and external opportunities. That doesn't exist anymore. It is all about reinvesting in existing businesses, existing operations, which is literally what every other company that you would buy would do, whether it's Coca-Cola. So that when I
Yeah.
say it's broken, like, it's become altered that much that optionality part doesn't exist in the same way anymore. And for me, I still hold shares. And to me, it's broken because I've had to rebuild Like, really, what is it now that it's just Adam Peterson and Alex Rozek is gone? It's just reinvesting our cash flows back into our existing businesses to make those more profitable and to grow them if we can.
All right. So let's wrap up with a question about our portfolios. So what is a stock or some stocks in your portfolio right now that you feel like the result of the stock price has benefited more from multiple expansion than from the actual results of the business?
So I want to talk a little bit more about NVIDIA, and then I've got another one I want to talk about too. And the reason I want to talk about NVIDIA is,
Well, I do too. So we'll both talk
yeah.
about Nvidia, and then we can go in the other direction.
So, and I don't know if it's more multiple expansion because you look at its like historical price earning ratios and things like that. It's not really a whole lot more expensive. Like if you
Right.
think about the
That's
forward.
my take. Yeah.
So to a certain extent, it has certainly earned a lot of what we've seen, but the expectations are all still exceedingly high for what is in essence still a cyclical business. And eventually that cycle is going to turn. And also we as much as like and I've made videos about it, we've talked about it a lot. It's like there's could be a ton of meat left on the bone for AI, for capital spending before we even get to the maintenance phase of CapEx for artificial intelligence focused semiconductor infrastructure. I mean, we could be talking 3 to 5 years of build out. Or we could also be talking in 2 years about you guys remember the AI CapEx bubble when everybody thought these companies were going to be spending all of this money and then none of them were making revenue and the wind kind of fell out of the sails. The reason I want to talk about Nvidia is it reminds me of like GE back in 2000. Now, it's a lot of different things there that are that make it not a fair comparison. I mean, we could use Microsoft. We use a lot of different like the stocks that actually let's use Microsoft because that's a company that like the business is a lot bigger now than it was back then. But like I think you know somebody that made a small investment in Nvidia, call it 20 years ago, and it's now it's worth like $1 million. And this is like a regular person that works a regular job.
Right.
So it's a substantial portion of that person's net wealth now. And you you have to start thinking about downside at some point with these massive winners where multiple expansion has helped you. Because again, I'm thinking about multiple expansion here is this bet that the earnings growth that we've seen is going to remain static, right? And even continue to grow from here. And that's a big bet to make when you're talking about something that can be such a large portion of your net worth, right? And somebody's made a ton of money for reasons that they weren't necessarily predicting would happen. You can lose a lot of money for reasons you weren't necessarily predicting happen. That happens a lot more often if we're honest, right? So you have to be thinking about execution risk, the cycle turning, all of those sorts of things happening that cost you more in losses that you really shouldn't incur because you were trying to capture a little bit more that you didn't necessarily need.
Yeah. I, I want to put numbers on NVIDIA really quick. Just this is not perfect, but I think it's directionally informative, right?
Yep.
Over the last year, and this is all trailing 12-month numbers, okay? NVIDIA's revenue's up 78%, free cash flow is up 125%, net income up 126%. PE ratio has grown 15%.
Right.
So that's why I feel like it's equal parts business, equal parts multiple expansion. All right, so let me give you the one in my portfolio that I think is the opposite, and then I'll see if you have one. I haven't mentioned it earlier, but I think it's a really good example. Let's use Broadcom. So semiconductor and other things company, basically, if you've used an electronic device, you've likely had a Broadcom product in it, especially if it was a mobile phone. Trailing 12-month revenue, up 19%. Free cash flow, up 5%. Net income, down 27%. PE ratio, up 141%. Now,
Right.
this could end up being correct if the projected growth and excitement around how AI will impact their business actually pans out. But right now, I would have to say that has risen to the top of my portfolio because of non-fundamental reasons, right? More because of multiple expansion, less because of business results. Would you agree with that?
Yeah, no, absolutely. Using the NVIDIA example again, their cash flows have gone up in the past 2 years 5x, right? Trades for 65 times operating cash flow. Traded for a lot higher multiple than that over part of the past few years. Part of the way I think about it too, and I think this is really valuable, is that you should pay a higher multiple for smaller, still growing companies, right? Growth businesses earn a higher multiple, right? As companies' growth stabilizes and slows, and they're not growing earnings per share, cash flows per share as quickly, that multiple should come down
Right.
over time. So that's another thing that you really have to be cognizant about when you think about multiples.
All right. What about you? Do you have one in your portfolio that you feel like has benefited more from multiple expansion than from business results?
Oh yeah, Enphase. Enphase is a
Mm,
good example. It's another cyclical. And it's interesting because their core business is tied to residential distributed solar, rooftop solar. And that business has gone through the first downturn in probably 6 or 7 years, maybe longer, maybe close to a decade, where there's just a massive down. Like their revenues from the peak were down like 60, 70%. You look at the past 8 or 9 months, the stock has gone up a lot, even as the results have deteriorated. So a little bit, it's like an extreme example of Texas Instruments. Like it's even worse. And there are, until the earnings they just reported a couple, I don't know, maybe a week and a half ago, there were very little indication that we had hit the bottom of the cycle. And now it looks like maybe we've hit the bottom of the cycle, but thinking about getting back to like the prior peak of demand, I mean, we're talking years and years. So stock price is still well down from the high, unlike Texas Instruments where the stock's still pretty close to all-time highs. But it's a lot of the same thing, because the market is always forward-looking, right? The market is looking for signs that the industry is going to bounce back, and investors want to get in as early as they can to when that cycle does turn.
yeah.
Okay, friends, thank you so much for listening. Go out there and give us a rating. Want to get out there too. Please give us ratings. We want more ratings. Only the 5 stars though. You can keep the other ones.
Yeah.
No, I'm kidding. They should give us those ratings too. Okay, friends, thank you so much for giving us another listen this week. And just a reminder, we're doing our live stream the Friday after you hear this episode comes out. So first Fridays, a few months in a row, it's been the second Friday, 4 p.m. Eastern on our YouTube channel. Be sure to tune in for that if you're able to. We'll, of course, put it in the podcast stream as well, so it'll show up there if you're not able to attend it live. As always, these are our answers to these questions. It is up to you. It is up to you to find your own answers to these hard questions about investing. You can do it, friends. I believe in you. All right, Jeff. We'll see you next time.
See you next time.